U.S. natural gas futures surged over 5% to above $2.20 on Friday, approaching a three-month high due to increased exports and reduced output. Major energy giants like EQT and Chesapeake Energy have cut back on drilling and completions, causing a 9% decrease in U.S. gas production this year. Gas output dropped to 98.1 billion cubic feet per day in April, down from a record of 105.5 in December 2023, and continued to decline in May. Also, gas flows to 7 major LNG export facilities in the U.S. have been climbing, following Freeport LNG's plant reactivation. The market is adapting to changes in LNG exports, notably with the upcoming launch of the LNG Canada project. This project, capable of processing up to 2 billion cubic feet per day, marks a significant boost in Canada's LNG output and could reduce exports to the U.S., potentially reshaping North American gas trade patterns. Additionally, U.S. energy firms have reduced the number of operational oil and natural gas rigs to the lowest since January 2022, signaling a possible downturn in future output. The count for gas rigs dipped by 3, reaching 102, reminiscent of figures seen in December 2021. This decline in rig count reflects a broader trend, with a drop of around 20% observed in 2023, following consecutive years of significant increases in 2021 and 2022. Economic factors and company strategies also play a role in the natural gas market. For example, in light of current conditions, companies like APA Corporation are adjusting strategies, planning to invest $2.7 billion in upstream oil and gas for the remainder of the year, an increase from previous plans, suggesting cautious optimism despite output reductions in the first quarter. However, the near-term outlook remains bearish due to high inventory levels. Looking ahead, weather forecasts predict mostly normal to warmer conditions until May 18. Significant bullish shifts would likely depend on substantial demand increases alongside ongoing production reductions. Confirmation of strength on both the monthly and weekly charts offers additional evidence supporting a bullish reversal from the February bottom. This suggests that the rally still has room to grow and might just be beginning. As I mentioned in late April forecasts, it would take approximately 2 weeks for gas prices to surpass the 50-day moving average threshold. Nevertheless, I anticipate sellers to return during a rally toward the 32-week moving average, and if bulls manage to protect last week's highs at $2.16, a decisive breakthrough could potentially reinforce the intermediate trend toward an upward direction. In the worst case, a resumption of the uptrend will restart from the 16-week moving average, strong support at the $2.06 level. Regardless, short-term dips should continue to be a buying opportunity, and I do think that eventually, hot weather will drive this market higher. Thank you for watching. Please like and comment to support the channel. See you in the next one.